Okay, so you're probably looking at the markets right now and thinking, wow, gold just smashed through $3,500 USD, a huge number.
It really is a major milestone.
And the big question on everyone's mind, the one you're probably asking is, what now?
But
What's
I
the
think
smart play here?
exactly. Is this it? The absolute peak time to, cash in your chips?
Or is this maybe just a pause? A little dip that
Think.
savvy investors should actually be buying into?
Or maybe, just maybe, the best thing is to just sit back, stay on the sidelines for a bit.
You want answers, right? You need to understand what's really going on, and, well, you need it clearly and pretty quickly.
And that's exactly what we're aiming for in this deep dive. We've been looking closely at a recent analysis from the Sun YouTube channel.
Ah, yes, their video titled Vanglap 3.500 USD Menwahai Thawat Hang. So gold peaks at $3,500 USD. Should you buy or exit?
Precisely. And our mission here is to sort of cut through all that noise, the excitement, the fear, all of it.
We want to give you the perspective you need, like how a seasoned investor might look at this, right? Helping you make clear-headed decisions, not just reacting emotionally.
That's the goal. Okay, so let's talk about this $3,500 number. It's definitely sent shockwaves, hasn't it?
For sure. Is this like the moment of glory for gold? Or could it actually be the start of, well, a painful fall?
When you see that number, $3,500, what does it represent to you? That's a good starting point.
Yeah. Is it opportunity, stability, or maybe even a little red flag waving amidst all the excitement?
It's so easy to get caught up. The risk, and the source highlights this, is buying right at the peak of that emotion.
And then facing losses when the market inevitably turns. That's the classic mistake.
It is. Because this surge, this move to $3,500, it didn't just happen randomly. There are real forces at play.
Long-term stuff, right.
Yeah.
The video mentioned things like loose monetary policy.
Yeah, lots of money being created. Plus, ongoing inflation that just doesn't seem to quit.
And geopolitical crises. Seems like there's always something happening somewhere.
And maybe a weakening faith in traditional currencies, those fiat currencies like the dollar.
So it's crucial, then, to tell the difference between a price rise based on those fundamentals.
Versus one driven mostly by, well, herd mentality, everyone jumping on the bandwagon, and raw emotion.
And right now, telling those two apart, that feels really tough. Is it real value or just speculation gone wild?
It's a challenge. And the media, social media, it all fuels that emotional buying, doesn't it? Seeing the price go up and up.
It creates this narrative, like it can only go higher.
Exactly. But that's dangerous territory. It reminds me of what happened back in 2011, something the Source video brought up.
Oh, yeah, 2011. Gold surged then, too, didn't it? To around, what was it, $1,920?
Close to it, yeah. $1,920 USD. And the story was similar. Gold as the ultimate safe haven during crisis. Everyone piled in.
But then
it fell. Pretty hard, actually. Within just a couple of years, it was down below $1,200.
ouch. That's a significant drop.
It really is. And think about anyone who bought right at that peak, driven by that FOMO, that fear of missing out.
They had a long wait. The video said almost a decade just to get back to even.
That's right. A very long, painful wait. A tough lesson in market timing and emotional investing.
So the question now is, could this $3,500 level be a similar situation? Another 2011 playing out.
Well, history never repeats exactly, but it often leaves similar clues, doesn't it? It rhymes.
And the biggest rhyme right now.
Peak euphoria. That feeling that everyone is wildly optimistic, and historically that kind of intense excitement. It's often an unsafe time for making big financial moves without a solid plan.
It really forces you, the listener, to think about where you stand in this cycle. Are you early, late?
Right. Did you get in lower, say $2,000, $2,400, or were you thinking about jumping in now near this $3,500 mark?
Because jumping in late, that's often where the most risk lies, isn't it? The late buyers kind of carry the bag if it turns.
That's often how it works. Following the crowd rarely leads to wealth in investing. You have to resist that urge.
And those predictions. Gold to $5,000. You hear them, but you need to think critically.
Absolutely. Markets move in cycles, peaks and troughs. It's not a one-way street.
So making decisions based purely on FOMO, it's just not smart.
It's really risky. You need to step back, look at the bigger picture like the source suggests. Consider past cycles, how much it's already run up.
Where the buying is coming from, and crucially, your own personal tolerance for risk. How much can you actually afford to lose if you're wrong?
Exactly. $3,500 itself isn't inherently a trap, but it can be a trap for someone without a plan, someone who doesn't understand the market, someone driven purely by FOMO.
The key question isn't just, will it go higher?
No, it's more like, what does this price reflect, and what's my downside if this isn't the home run I think it is?
Because those highest prices often align with peak emotion, right?
Almost always. And more emotion equals more risk in investing. Professionals know this. They're always balancing risk and reward.
Which requires staying calm, thinking clearly, and deliberately not following the herd when it seems irrational.
And speaking of professionals, what are the big players doing, the so-called smart money?
Yeah, the video touches on that. When things get this frothy, they might not be buying.
They might actually be quietly adjusting their positions. Selling, perhaps.
So while small investors get excited about $3,500, the big institutions, maybe even major gold ETFs like SPDR, they could be reducing their holdings.
It's possible, and their reasons wouldn't be emotional. It would be strategic, taking profits, rebalancing portfolios after a big run-up.
They don't wait for the crash to sell, do they?
Often, no. They might sell when things look the absolute best, locking in those gains.
And the danger for the individual investor is seeing all the positive headlines, the bullish analysis.
And believing it's a sure thing, not realizing that the people potentially fueling that sentiment might be quietly heading for the exits.
Gold doesn't speak, but the flow of money does.
Yeah.
I like that quote from the source.
It's a powerful reminder. Follow the money. Where is it actually going? Peak emotion rarely lines up with sustainable profit peaks.
And the source specifically mentioned SPDR Gold Shares, the biggest gold ETF.
Yeah.
Seeing significant outflows recently. That seems telling.
It's definitely data worth considering. Now, central banks are still buying gold, but that's different. That's about national reserves, long-term strategy, not short-term speculation.
So their buying doesn't necessarily mean the price keeps rocketing for individual investors.
Right. Meanwhile, investment firms might be quietly getting out, leaving the enthusiasm to the crowd.
Which begs the question, if the big players are selling, who's buying at these levels?
Well, the video suggests it's often newer investors, or people caught up in that intense FOMO, afraid they'll miss out on even bigger gains.
There's that harsh market rule, isn't there? The wealthy often sell to the least informed at the end of a cycle.
It can happen. It's often about planning versus emotion. Seasoned investors sell based on plans. Newcomers often buy based on peak emotion, and then sell out of fear later.
The video drew a parallel with Bitcoin too, didn't it? When it surged past $60.
Yes, exactly. Remember all the talk. $100,000 Bitcoin is inevitable. The feeling was unstoppable growth.
And then a major correction.
Right. The underlying value of Bitcoin might still be debated, but the timing of entry was critical. Lots of late buyers got hurt.
And that's the potential lesson for gold at $3,500. Long-term value might exist, sure, but is this specific price point a good entry? Maybe not.
If the people with the best info and resources seem to be shifting course, the video suggests you should probably pause and reconsider your own strategy.
Are you going to act based on emotion, on that FOMO?
Or are you going to observe, analyze the data, and act based on a well-reasoned plan? That's the crucial distinction.
So we land back at that dilemma. Gold at $3,500, hold, exit, or wait.
And like the source says, no chart pattern alone gives you the magic answer. Each choice has its costs, its risks.
It takes courage to choose correctly when the market feels this emotional, this tempting.
Absolutely. Now, if you bought earlier,
Yeah.
say $2,000, $2,400, congratulations are in order. You're sitting pretty, on paper at least.
The profit isn't real until you sell, right?
Exactly. So the decision becomes hold out for maybe $4,000 or start taking some profit off the table now. That's a test of discipline.
Professionals sell not always out of fear, but because they know catching the absolute top is rare. Knowing when to stop is key.
That's right. They understand that securing a good profit is better than gambling for the very last dollar.
And for those not yet invested, the advice seems to be caution. Don't just jump in because the price is hot and FOMO is kicking in hard.
Definitely. Ask yourself tough questions. If gold drops back to $3,100 or even $2,800, what's your plan? Hold tight. Panic sell.
If you don't have a clear answer.
Then maybe observing from the sidelines is better. Losing a potential opportunity hurts less than losing actual capital. Patience can be incredibly profitable sometimes.
What about someone who did buy recently, right near this $3,500 peak?
The advice there is pause, take a breath. Don't chase it higher without understanding why you invested, and don't blindly follow predictions.
What's needed then is a risk management plan.
Absolutely. If the market reverses, what will you do? If you don't have a strategy, focus on developing your investment thinking, not buying more gold right now.
This really all comes down to your identity as an investor, doesn't it?
It does. Are you just chasing prices? Acting out of FOMO?
Or are you a genuine investor with a strategy? Someone who acts based on analysis, not just gut reaction or crowd excitement.
Markets fluctuate. They always will. But those who stay calm, have a plan, and think clearly, they're the ones who tend to be resilient long term.
You don't need to be right all the time.
Just right when it matters most, often when the market itself seems to be wrong. And that usually means going against the crowd sometimes.
Resisting those emotions, standing on your own analysis.
Exactly. Which leads to another critical point the video raises. Is $3,500 gold reflecting true value, or is it more of a market illusion?
Right, fundamentals versus sentiment. True value comes from underlying factors, not just the price tag at any given moment.
When gold hit $3,500, the market split. Bulls and bears. The key is figuring out if $3,500 is reasonable based on data or just driven by emotion.
The video looked at basics, like cost of production.
Yeah, currently estimated around $1,200, $1,400 globally. So $3,500 is what, roughly 2.5 times that?
That's quite a premium. Of course, gold isn't just a commodity, it's a defensive asset, a kind of stateless currency, a symbol of trust.
True. But the question then is, are current trust levels, or maybe distrust levels and other things, so high that they justify that much of a premium?
We know the drivers since the pandemic. Low rates, money printing, soaring debt, maybe a weaker dollar.
And the source makes a good point. Many of those factors were probably already priced in when gold was hovering around $2,000 back in 2022, 2024.
So is $3,500 a logical continuation? Or is it the market getting disoriented, reacting more than thinking?
It makes you think about past bubbles, doesn't it? The video mentions the tech bubble in 2000.
Yeah, tech stock prices completely detached from earnings because everyone believed in endless growth until they didn't.
And the 2008 U.S. real estate bubble, the belief that prices could only go up fueled a massive crisis.
Could something similar be happening with gold? Not because gold itself is flawed, but because faith in its constant rise has become excessive, maybe blind.
That's the risk. Market crashes often happen less because of bad data and more because herd mentality shifts rapidly, from FOMO to panic selling.
And the speed of that reversal, it can catch everyone off guard. Logic goes out the window.
So at a peak like this, the video advises asking critical questions. Like, when everyone is bullish and telling you to buy, why aren't they just quietly accumulating more themselves?
Good point. Maybe that widespread belief isn't strategic confidence, but just contagious emotion.
It relates to that old saying, in investing, the majority is usually wrong. Why? Because the majority often acts on emotion, not plans. They buy because others are buying. They hope because they fear missing out.
Investing isn't about being popular, it's about being right, sometimes when everyone else is wrong. Sticking to your guns when the crowd rushes.
The right question isn't just, what if gold keeps rising, but maybe more importantly, if I buy now and it corrects sharply, can I handle it, financially and emotionally?
Because that herd mentality causes buying errors and selling errors. Panic selling at the bottom is just as bad.
Exactly. The market rewards being in sync with fundamentals, not just reacting fast. So it comes back to basics. Assess value, manage risk, maintain discipline.
Doing what the crowd isn't doing is often key to long-term survival.
Whether gold goes higher from here or corrects, the decisions you make based on clear thinking today, those are what will shape your financial results tomorrow.
So wrapping up this deep dive, our goal was really to bring some clarity, a more strategic view on this $3,500 gold price.
Yeah, hopefully empowering you, the listener, to step back from the noise and make decisions that are informed, not just emotional reactions.
We hope you'll consider the questions we've talked about and keep exploring the gold market with a critical eye.
Absolutely. Keep thinking for yourself.
And maybe a final thought to leave you with. In a market driven so much by fear and greed, perhaps your greatest asset isn't picking the perfect top or bottom,
but rather having a well-reasoned plan and the discipline to actually stick to it, no matter what the headlines are shouting.